If you are receiving a part or full age pension from Centrelink, there is a high probability you may be hiding cash at home to avoid your age pension being reduced because of the assets and income tests that Centrelink applies in determining your entitlement. In this video, I'm going to share with you the pitfalls and risks of adopting this approach, as well as ways you can legally manage your cash so it doesn't impact your age pension. Hi, and welcome to the Retire Well project. My name is Bourne, and I'm a retired financial advisor with a passion for helping people navigate the complexities of maximising their entitlements through the age pension and superannuation after retirement. Over the years, I have helped thousands of individuals and couples manage their retirement. And one of the least talked about methods of maximising your age pension is hiding actual cash from Centrelink. Very few people admit to it, but we all know it's a common practice, even though everyone knows it's illegal. During my years as a financial advisor, I had several clients admit to this. Despite people knowing that these practices are illegal, I've seen an underlying impulse in many people to get what they feel is their full entitlement to the age pension after they've reached retirement. Many think that after years of paying taxes, they're entitled to receive their full benefits. Let's talk about the pitfalls of this approach. Deliberately failing to declare assets or income to Centrelink is considered welfare fraud. This is a criminal offence in Australia and can result in fines, repayment of overpaid benefits, criminal charges, or even potential imprisonment. Centrelink uses sophisticated data matching systems to detect discrepancies in financial information. They collaborate with banks and financial institutions, the Australian Taxation Office, ATO, and other government agencies. If you're caught, you may face retrospective assessments and be required to repay benefits you weren't entitled to. If Centrelink discovers undeclared cash, they may suspend or cancel your age pension payments and apply penalties, reducing your future entitlements. Keeping large sums of cash at home also comes with risks. It increases the risk of theft, damage from events like fire or flood, or even misplacement, leaving you without access to those funds. Cash kept at home doesn't earn interest or grow in value, reducing your overall financial security. Being caught hiding assets can damage your reputation among family, friends, and the community. The fear of being caught can also cause significant emotional and psychological stress. Hiding assets may not only affect your age pension, but also other Centrelink payments or concessions, such as rent assistance, healthcare cards, or other government subsidies. Additionally, if you later deposit the cash into a bank account or use it for significant purchases like buying a new car or caravan, Centrelink may question where the money came from, which could trigger an investigation. With advances in technology and the use of artificial intelligence software, detecting fraud is becoming easier for government agencies. There is also a trend towards a cashless society. The government is fully aware of the impact hidden cash has within our society, and there will likely come a time when every transaction or purchase you make will need to be digital. Already, we're seeing many shops not accepting cash, and this will likely become mandatory in the not-too-distant future. What I also discovered during my years of helping clients is that many people are unaware of the legal ways to manage their money, which could actually increase their age pension entitlements. Let's go through some of the most common and legal ways to maintain or increase your age pension entitlements. The first is purchasing a complying lifetime annuity. Lifetime annuities are sold by banks, insurance companies, and other financial institutions. A complying lifetime annuity purchased after 1st July 2019 is treated favourably under both the assets and income tests for the age pension. Under the assets test, only 60% of the purchase price is assessed up to age 84, or a minimum period of 5 years, after which only 30% is assessable for the remainder of life. Under the income test, only 60% of the annual payment is assessed. To qualify for these reduced assessments, the annuity must meet the conditions of the Capital Access Schedule. For example, a death benefit can be paid in the first half of life expectancy up to 100% of the purchase price. After reaching the midpoint of life expectancy, the death benefit reduces in a straight line until it reaches zero at life expectancy age. An annuity can be purchased with superannuation monies or with funds outside of superannuation. If you're over 60, retired, and use funds from superannuation to purchase the annuity, then the income is tax-free. For example, if you purchase an annuity for $100,000 and it pays $5,000 per year, the assessable income is $3,000, which is 60% of $5,000. If the funds remained in superannuation, the deeming rules would apply, with the worst-case scenario being assessed at the highest deeming rate of 2.25%, or $2,250. It's also possible to purchase an annuity and defer the income payments. For example, if you purchase an annuity at 67 for $100,000 with funds from superannuation but defer income payments until you turn 80, the annuity reduces your assessable amount to $60,000, which is 60% of the purchase price, and also reduces the deemed income on the funds you used to purchase the annuity until you start receiving an income. The second legal method is using the gifting threshold. The gifting threshold allows you to give away up to $10,000 in a year and $30,000 over a rolling 5-year period. For example, if you purchase a new car and gift your old car, which has a market value of $12,000, to your daughter, only $10,000 will be exempt. The excess of $2,000 will be counted as a deprived asset for 5 years, under both the assets and income tests. The third method is transferring funds to a younger partner's superannuation. If one partner is over 67 and receiving a part-age pension, and the other partner is younger, it's possible to transfer funds into the younger partner's superannuation. These funds will be excluded from the assets and income tests until the younger partner turns 67 or starts an income stream after age 60. Currently, the maximum tax-free amount you can contribute to your partner's superannuation is $120,000 per year. If your partner hasn't made any tax-free contributions in the previous 2 years, they can bring forward those unused limits, meaning it's possible to contribute up to $360,000 in the 2024 to 2025 year as a tax-free or non-concessional contribution. The fourth method is spending money on home renovations. Your home is an exempt asset and not included in the assets test for calculating your entitlement to the age pension. Any funds you spend on renovations are also exempt. For example, if you spend $10,000 on home improvements from funds that are currently being assessed under the assets and income tests, this could potentially increase your age pension by $780 per year under the assets test. There are several other methods to legally manage funds and maximize your age pension entitlements, which we will cover in our next video, as some are quite complex, such as establishing a granny flat, purchasing funeral bonds, prepaying funeral expenses, or paying accommodation deposits for aged care. I hope this video has been helpful. If you have any comments, leave them in the description below. Subscribe to the channel to stay updated with new video releases. Thanks for watching.